Well, good afternoon, everyone, and thank you so much for joining us on this webinar. I'm Dorian Nunez, president of Omni Research, my own institutional research and consulting firm, and a senior fellow at Intentional Endowments Network. And we're excited to be hosting this conversation today on the case for diverse and women-owned alternative GP staking and seeding. For those of you who are not familiar with Intentional Endowments Network, here's a quick overview. We're a peer learning network advancing intentionally designed endowments through resource exchange, education and training, and forums and meetings. Or as I like to say, we're trying to save the planet in the most inclusive way possible. We have over 200 members. That's made up of university endowments and asset owners, controlling over 120 billion with a B dollars. Our asset managers control close to 14 trillion in dollars. And we have service providers, consultants, outsourced CIOs, and a number of other organizations that are members like ICCR, DAMI, NAIC, PRI, CIRRUS, and others. If you aren't a member, let's encourage you to join. Today's conversation in celebration of Women's History Month focuses on the role of women-owned alt managers. There's an unmet need, and we didn't know this already, but there's an unmet need for diverse and women-owned alternative managers to source equity, staking, and seed capital. And so we're delighted to have this particular panel. Before I pass this on to our great moderator, here's a few housekeeping tips. The webinar is recorded. The webinar will be shared, the recording will be shared with participants and other IEN members, and we will circulate slides and resources from this conversation. So you don't have to type in the chat room, will you send us the slides or is this recorded? But you can use the chat room to comment and to request technical help. Use the Q&A function to ask panelists questions, and there'll be time for Q&A at the end of the formal presentation. Participants will remain muted for the duration of this webinar. I am personally and particularly excited to have one of my old partner, Tina Williams from Exponents. We won't say old in terms of age, just to say experience, who's one of our prime speakers. So, exactly. Experience. I've known Tina since when she was a trustee at a public pension fund. And so that could tell you how far back we go. But our moderator, Lisa Hines, is a rock star on her own, and we could do a webinar on her. She's written a book about faith investing. She's served on a number of trustee panels that I won't go into. She's worked for Morgan Stanley and Entrust, and now she's at Exponents. And I could go on, but I won't for now. I'll just turn it over to our great moderator, Lisa. And thank you very much to IEN and to all of you other panelists for coming together and working with us.
Dorian, thank you. Thank you, Dorian, for that very, very kind and generous introduction. Let me also offer my welcome and my thanks to our partners and friends at IEN, to all of you, our guests who have joined us today, and to our esteemed panelists who, for the next 40 minutes, will deconstruct the investment thesis, philosophy, and process of GP staking and seeding, as well as the inherent and essential value of diversity that underlies that thesis. Again, my name is Lisa Hines, and I am part of the client engagement and sustainability team at Exponents, a multi-strategy institutional investment management firm headquartered in both Philadelphia and Durham, where we believe quite simply that alpha is generated through access. As we close out a vibrant Women's History Month, our very topical panelists assembled today are leaders and founders and pioneers and girl bosses from a variety of investment strategies. They have not only earned a seat for themselves at the proverbial table, but more importantly, they've built new tables. Joined today are Jennifer Rizza from Eversource, Cherise Clark Suarez from Harborview, and Tina Biles-Williams from Exponents. So let's get right into it. I'll ask each of you to briefly offer an introduction of yourself, your firm, and some of your very boss moves that you've made in the industry, particularly as it relates to diversity, equity, and inclusion. Jen, can you please lead us out? Then we'll turn to Cherise and then Tina.
Sure. Hi, everyone. My name's Jen Rizza. I'm a trust investments manager at Eversource. If you're not from New England, you may not be familiar with us, but we are a regional utility. We cover Connecticut, Massachusetts, and New Hampshire. While the company does have energy in its name, it does have a very strong commitment to DEI and sustainability initiatives. We support DEI at the leadership level across the entire workforce, and also in the communities that we serve. So in addition, we have an industry leading initiative, a goal of being carbon neutral by 2030. And we've received numerous awards, probably too many to mention on this call, but numerous awards and recognitions for both our DEI and our sustainability efforts. And with respect to my responsibilities, I work with the team here. We're primarily responsible for the pension investments, overseeing those assets of about $6 billion. And we do align our DEI and ESG with the corporate goals as well. We don't have stated initiatives, or we don't have stated mandates in terms of exposures, but we do have about 12% of our assets currently allocated to diverse managers. And we have not invested in any new capital in upstream oil and gas companies since 2019. So we're aligned with the company, and we work to have, definitely an eye on ESG whenever we're hiring managers. We want to make sure that they have policies in place at the firm level and take into consideration ESG risks as they're making investment decisions. And specifically with GP stakes, which is the topic today, we are active investors there. We generally invest through funds. Fund investments. We do have one fund that we're invested in that has a focus on diversity managers. And we also have strategic partnerships with other GP stakes managers. And we really like the space. We think it provides a really good source of uncorrelated returns to the rest of our portfolio. We think it's a great way to identify emerging managers in the space that we want to continue working with. Either through their funds or through direct co-investments. And we also think DEI is just a great way to play the space, whether it's through a dedicated fund or a fund that has seed investments that focus on DEI managers.
Thanks, Jen. Charisse, you want to?
Yeah, absolutely. Thank you so much for having me, Lisa. So nice to be with all of you and happy to share a little bit about my background. My name is Charisse Clark-Suarez, and I'm the founder and CEO of Harborview Equity Partners. Harborview is a private equity and asset management firm focused specifically on the entertainment and media segments. We started about 2 years ago after leaving a previous platform that I started called Tempo Music. I started with a $1 billion launch with Apollo to buy music catalogs, so very fun and interesting segment of the market, but also one that offers really good non-correlated returns. Since then, we have launched a couple other investment products, including our Royalty Fund One, which is what we're out in the market talking to participants about today, and we are excited to have done several closes against that. Our team is about 20 professionals full-time, and we've got about 5 additional consultants that support the business. So we built we tried to intentionally build an institutionalized framework and platform that we felt like we could attract high quality LPs and partners. We have, in our relationship with Apollo and a few others, taken in relationships that we felt were really going to be helpful to motivating and creating momentum for our platform. So we're really excited about those partnerships. And lastly, as it relates to team, we've been very thoughtful and successful in building out a team that looks like the world. It's been really important to me that everybody on our team has a mirror to look into and a window to look out of. And so that's been a really important focus for how we've been building our team. And so if you look at one of my favorite pages in our presentation decks is always our tile page of all the different people and different perspectives that you can visually see, but then also what you would see if you looked at their resumes is that we've also got diversity of thought and experience. And we really try to come together using an old 80s baby adage of trying to be a Voltron, if you will, of building and having different skill sets so that comes together to really create a superpower. So that's us in a nutshell. We're very excited to be here. We feel fortunate to have had the growth that we've had over the last couple of years, but it's been in due part to great partners across the ecosystem.
Thank you, Charisse. Tina?
My name is Tina Bowes-Williams. I am the founder of Exponence. I founded Exponence. It was previously FIS Group, but in 1996 was and Lisa alluded to this, that we believe that greater access in our business is a source of alpha. And so everything we do is based on that premise. And there are two ways in which one can do that. One is simply through returns, and we have a multi-asset profile in both public and in private markets. But the second way one can do that is by being a force multiplier for other investment firms. And we do both because we think it's important, both for client partners, but also for the industry writ large, to increase the pipeline, so to speak, of great diverse and woman-owned investors, as well as in the case of GP staking, where we provide acceleration capital as well as strategic capital to help them meet whatever their growth objectives may be. And so that could be, re-optimizing their cap stack, or, if they're private equity, buying a private debt platform, or providing GP capital for additional strategies. The main goal here is to assist already world-class GPs to meet their strategic objectives through a combination of capital and strategic advice and support.
Great, Tina, thank you very much for that. We have some would-be GPs in our audience today. So for Sharice and for Tina, can you please tell us what inspired each of you to launch your own investment firms? And please specifically also maybe address the inefficiency or inefficiencies that you are seeking to address in your investment strategy.
Sharice, you go for it.
Wow. Well, I mean, a few things. One is I tell people sometimes, you may have heard me say I'm an accidental entrepreneur. I didn't know that I had the risk tolerance, candidly, to really start my own firm. I'm, a significant contributor to my household income. I've got small kids. I've got aging parents. I've got, as a woman of color, we have usually second and tertiary responsibilities in addition to those family responsibilities. Like one of my dear cousins, it was like, I just showed a college tuition just showed up on my desk. One of our family members was migrating to the US and wanted to go to school, but her parents did not have, so we all had to chip in. So like that is the responsibility of who we are. And so that means that taking entrepreneurial risk can feel hard or almost impossible, or like that very expensive store that you walk past on Fifth Avenue and you decide there's no point in going in because I can't afford a Hermes bag, right? So that's how entrepreneurship felt to me. While I was at Morgan Stanley, I got the opportunity to start to develop a product. And as we were developing that product, it felt like it was more natural for that product to live in a standalone world. And that was a feedback investors were giving me, and they were kind of expressing confidence to back me. So that's what started my first platform. And then I left that platform because I ultimately didn't know what I didn't know. At the time, I didn't negotiate, owning enough of that. And so I saw an opportunity to create a firm that was really grounded in the values I believed in the opportunity I was seeing across the entertainment and media segment, as well as the ability to really build the next generation of asset managers. So much homage goes to all of the original guys, right? So the Apollos who I've partnered with, or the Providence Equity Partners who gave me my first shot, or people like KKR and Carlyle, lots of homage to them, and very proud of all the things that they've been able to do. I think our firm, as the next generation of all that, is one where we're centering, a seat at the table for everyone that looks like me at the firm. But not only that, really seeing market opportunities that are probably too small for them to focus on a day-to-day basis, but really kind of in the sweet spot of things that we think are really, really interesting. And then lastly, for us, we've taken a specific industry point of view where we want to be able to meet great entrepreneurs or great assets in the entertainment and media segment and have flexible capital solutions to service that audience. And, we think that there is a lot of value to be had in that space that is undercapitalized or under recognized from an institutional capital perspective. So our goal is to build an infrastructure that builds rigor and structure and gives investors the opportunity to get access to truly non-dilutive returns across those segments. So that's it. That's the inspiration and all the things. But thank you for that question.
Yeah, thank you.
So the idea that I fundamentally believe that the investment industry, the allocation of capital in our industry is inefficient in the sense that the flow of capital does not comport with the return opportunity. And that's something that I observed from when I was the chief investment officer of a pension fund in the late 80s and early 90s. And so I didn't have, all the multitude of studies, the Knight Foundation, the NAIC study that demonstrate that diversity is either a driver of alpha or certainly not a destroyer of alpha. I didn't have anything like that. Those studies back in the, in the late 80s or early 90s, but it just made no sense to me that, the pool of investors were so homogenous. Like Sharice, I grew up in a country where it's very used to seeing women and people of color lead in all walks of life. There's another thing that, there's an investment theory that says that your performance success is a function of your ability to choose well, your selection skill, and the breadth of independent opportunities from which you have to choose. And I did not see a lot of independent opportunities. As I said, I saw a very homogeneous group of choices. And so for me, what I saw was an investment problem, not even a social justice problem. It was an investment problem. And so, as we start to talk about the opportunity in GP staking, what we are addressing here is that investment inefficiency where mid-sized GPs, diverse GPs have shown to perform really competitively, but the capital does not reflect that. And that's the breach that we're trying to fill. And so that's what Exponence, that's why I started the company, and we continue to try and address that challenge.
Thank you, Tina. Thank you, Sharice, for addressing that notion of inefficiency. Jen, if we can turn now to you, maybe you can help us unpack this notion of founder fit, specifically as an allocator, and for you, Tina, as well, specifically as an allocator. Can you speak at all to the key factors that you analyze to determine who might be an appropriate or even an optimal partner? And also speak to the types of returns on capital that you're seeking with this type of investment.
Yeah, sure. So I guess at a high level, again, we tend to invest through funds, GP stakes fund managers, not necessarily directly, although that is an option for us to do once we've kind of established a partnership with some of these managers. So at a high level, our philosophy is always kind of lower middle market space. We think that's an inefficient space to be investing in. So even with respect to GP stakes and seeding strategies, we don't invest with, and the names, the Dials, the Blackstones, we're not looking to invest with them. We're looking more in where there's a lot of more white space, as Tina alluded to, where there's a demand, but there's not a lot of capital going into those spaces. So that's first and foremost what we're looking for, is just to kind of fit that profile. For GP stakes, usually it's, the one or two funds in, looking for some economics there. Seeding strategy is a little different. And I know, there's some folks in the audience that might have some questions around terminology as well. Our seeding strategies that we're looking for are very early, either pre-fund one or fund one managers. And this applies across whether it's emerging and or diverse managers as well, because I think everything does apply kind of similarly. There's a lot of intersection of those two groups. But you're looking for managers, especially in the staking space, at an inflection point. Kind of growth can take off. You can take a 500 million AUM manager or $1 billion AUM manager. You can double that fairly easily. So 2 times your money pretty easily. There's good economics. There's great opportunity to get fee-related earnings off of that, income, any other piece of the economics that you can get. So for the staking strategies, there's an income component, uncorrelated return component, probably high single digits sort of cash on cash returns, and then, really private equity type returns at the end of the day, but without taking what we think is private equity risk and volatility. So again, it's kind of we put it in our real assets allocation, to be honest with you. So those of you looking to invest or allocate these types of strategies, you can, PE might be a little overweight, but you can argue that this might actually be a good real assets allocation, which is what we do. Underwriting these managers, we do rely heavily on the fund managers that we employ. But it's pretty, it's basic. It's, you want there to be a good alignment with management. You want them to have, in the stake strategy, some track record, and even in the emerging managers strategy, some track record there. You want to be aligned in terms of philosophy. You all want to, this is a long-term investment. They're growth oriented. You don't want them just cashing out. Obviously, this is capital that they're going to use to grow their business. And overall, we like diversification. So Sharice's strategy is very unique. It's a niche strategy. We love kind of sector focused strategies, things like that we can build a portfolio around. So I think, again, we're not just going into everyday buyout funds. We're going into more either sector focused strategies, strategies that, have some kind of unique niche to them. So the returns, I think we touched on that. Exit's another story, which we don't have to touch on, but these are long-term investments. So, the exits for us, are going to be, we prefer not an IPO, because I think you're always subject to the whims of the public markets. Managers can, buy you out. You can, you can create a structured product around this, because it does have some income components. So there are ways to get liquidity out of this, sell it back to the manager. Manager could be acquired. There's different ways to get liquidity. I think as the area matures, or the asset class, I'll call it, matures, there will be more and more opportunities for us to be able to liquidate and monetize these investments in secondary markets.
Awesome. Thanks, Jen. That was very helpful, particularly with respect to where you bucket these types of investments. Yeah. The importance of alignment with mission, sector specialization, and the notion of diversification when it comes to these types of investments. Tina, what are the metrics? What are the factors that you seek?
So I think it might be helpful if Bella could throw up, thank you, slide 2. So this kind of characterizes the market. First of all, Jen mentioned some of the, larger, well-known GP stakes firm, and it's essentially the bars to the right on the chart to the left is where they play, and that's where. But the where we play is the bars to the left, and there's a very simple reason. What is it, Wayne Gretzky that said you want to go where the puck is going, not where it has gone. And so we think that if you look at GP the growth of GPs and GP stakes are actually where we're focusing on and where most of the industry is not. I spoke about the opportunity with diverse versus non-diverse managers, and you can see, first of all, diverse managers are obviously overrepresented among the smaller GPs. And, a focus on smaller GPs also leads to diverse managers, that's another way of saying it, who, as you see in the chart to the right, have actually performed really competitively. As it relates to what we look for, if you could turn to the next slide. And so focusing on the box to the right. Look, we're not investing necessarily in funds, we're investing in businesses, the GP itself. And what a GP stake is, it's a minority position in the cap structure of the GP. And as Jen alluded to, the economics is some portion of their management fees, their promote, as well as, an exit. Those are the sort of constituents of the economics. And so we have a minority position. So if you have a minority position in anything, you really have to trust the people, right? You have to trust, that they're honorable people, but you have to believe in their business plan, because essentially you are betting on the growth of their business and their ability to execute on their business plan, whatever that business plan may be. So strong leadership, trustworthy leadership, folks, principles that are aligned with us, and equally importantly, their LPs, so strong governance practices, third-party validation of, their portfolios. We have to believe that they can successfully raise capital, because again, we are betting on the growth of the GP itself. Right. Now, in a number of cases, we will work with the GP to raise capital, but we have to have sort of a core belief that they understand the business and they understand how to succeed. Again, a compelling business plan, and growth-oriented use of transaction proceeds. In other words, when they get our capital, we want to make sure that it comports with their business plan, and it in a compelling way. In terms of what we're trying to achieve for LPs, and we're very honored to count Jen as one of them, is we want to underwrite to a 3x MOIC. We generally negotiate deals in which we get a 10% cash yield, which is why Jen said this is particularly in an era in which PE multiples are a little rich. This provides a bit of a ballast in terms of return. Great downside characteristics because of the fact that the cash yield is based on in-the-ground management fees and carry. And exit options. One of the knocks, quite frankly, on GP staking, and it's a legitimate knock, is, okay, how do I exit, right? Are you a perpetual partner, minority partner for your underlying GPs? We believe that another advantage of focusing on, small and mid-market GPs is that it actually increases your opportunity for exit. They're growing faster. And if they're doing what, if they're successful entrepreneurs, they actually will want to get rid of you. I mean, when I think of my own firm, GP staking didn't exist when I started my firm, but it was a very similar deal that I was financed by a very similar deal that we strike with our current GPs. And so, I had a call option to buy out my investors' warrant on the equity in my firm. And as soon as I can, I did. I did it in 4 years. That's usually, if you have a not successful entrepreneur, that's what they will typically do. But you have strategic, greater opportunity for exits from strategic buyers in the smaller and mid-market segment than you have with the sort of large mega fund segment. But so that's what we look for, and that's sort of what we underwrite for.
Great. Thank you. Thank you, Tina, specifically for highlighting the different return profile, the unique return profile of a GP investor versus an LP investor. Very, very helpful. Charisse, if we could turn now to you. So you founded Harborview Capital, a GP of stellar institutional quality. There is this notion of founders fit as it pertains to you as well. Besides capital, can you speak a little bit to the metrics you use to determine who the optimal strategic partner might be?
Yeah, it's a great question because, it is one that we are constantly thinking through. We are been fortunate enough to not necessarily be in a place where we need to bring in partners, but we want partners because we know that we're aiming to build an institution. We don't just want to have, one small fund that we think is really interesting and delivers really great returns. We actually do want to build the next generation of what an institutional asset manager looks like. And, obviously that does direct investing. So for that means partners who bring some, look around the corner experience, like, hey, we've seen this before, here's how to think about this. Partners who can help us to open the Rolodex. We do know that obviously raising capital is really about reps and about seeing as many great partners as you possibly can see. And we're, we know that we're mighty, but we're still small. So, getting partners who can really help us to open up the depth and the breadth of LPs who we'd love to serve with our asset class is really, really important to us. And so partnerships around that. And people who really kind of believe the vision. I think that's a real piece for me, right? Is, an entrepreneur and a CEO is a perpetual optimist. If you don't believe, no one else believes. So sometimes you're falsely believing, but you have to believe. You have to believe that you can get there. And so having people who believe instead of doubt your credibility is a big part of it too, and yes, there's always good downside planning and downside scenario planning and making sure you have, I grew up as a credit girl, so I get it on kind of underwriting the downside and knowing how to protect the downside. But having people who really believe in the vision and want to be there to help to be the fuel for that vision is what I would be looking for in a partner. It's the same way that we position ourselves to businesses that we may want to partner with, right? We've met a lot of CEOs who are looking at us to partner with us on capital and things that we do outside of music royalties. And one of the things that I feel every time they tell the story is I tell them, you know what, I'm an entrepreneur's entrepreneur because I'm living, building a company. I get what you're going through. I may not be doing and building it to your widget, but I understand the peopling. I call it peopling instead of modeling. I used to do models when I was more junior in my career. Now we've got a team to do that. Now I do all the peopling, which is, that's a huge part. And it's a big part and a critical part of your success. And so how to think about that, how to think about creating culture and motivating people. So partners who get that and who understand that and who want to be along for the ride to help me build that. That's what I'm looking for in a partner. If you just want to be like, hey, we figured out how to buy low, sell high, and you're going to litigate every single line item in a document to extract the most value from me at a point of either your perceived weakness or actual weakness, that feels like less of the partnership for us. Because that's not the energy we want to exude every day. It's also not the type of firm that we want to build. And there are investors that like that type of strategy, but that's just not us. And so similarly, I don't want partners that treat us that way either. So those are the types of things that we're sort of looking for. And really looking for people who really think and believe in what we're building, believe in the culture that we're trying to build, believe in the investment products and the thesis that we have, and believe that, with the right fuel, we can get there.
Awesome. Thank you, Charisse, for underscoring that, the importance of the belief system and sort of the look around the corner kind of capital. Very, very helpful. We've got about 5 minutes remaining. If maybe we can talk about maybe in our last few minutes to the best practices and processes specifically with respect to access to capital. Jen, maybe we can begin with you. With what you have seen in the industry as sort of best practices and processes when it comes to access to capital. And then maybe Charisse and Tina, you can close us out with your experience in your journey to access to capital.
So we're a provider of capital. So I would say, those managers that need capital, like Charisse, there's plenty of allocators out there. I know it's kind of a fit thing, for sure. But I think, for us to provide capital, we just need to have, a clear set of, is it profitable? These are profitable businesses, very profitable businesses. Do we want to back them and participate in that profitability? And for us, giving that, talking to our committees and getting them on board with that type of a thing, it's an easy ask for us, as an allocator, as a capital provider. So from my perspective, it's kind of an easy job to tell the story and to get buy-in and to be able to allocate to these managers that need it. And I guess it's a matter of other allocators coming around our way of thinking, because we're maybe a little more ahead of the game when it comes to that.
Right. And Jen, maybe if you could maybe give us an example, if you can, of maybe something that maybe didn't quite work so well from the seat that you're in.
Gosh, a lot of things. I would say getting into, and this is GP stakes specifically, so I guess it does make sense to share, but, in terms of the space that we look at, we went outside of our what I said was, we focus on lower middle market. We did go outside of that initially, and we invested with a manager that didn't do that. And you can see the results were, they were what they should have been. You get into lower middle market GP stakes, you're going to get PE-like returns. You go into emerging manager stakes, you're going to, you're upping the risk a little bit, but you're going to get much better return profile. We went with large cap. We went with, some hedge fund exposure, not necessarily just private equity managers. And now we're working through, I think we're going on 12 years now with this manager to get an exit. So when you kind of, get outside of your lane a little bit too much, or don't stick to what you really know from a philosophical investment perspective, you kind of have to pay the consequences there. So I would say that was one thing that went wrong within the GP stakes, where we're really more dedicated now, more than ever, to investing in kind of more the middle market space, emerging manager space, and diverse managers, which again, I just reiterate, really does it's a more sustainable and impactful way of investing, and it makes the conversation with our committees a lot easier when we are making those types of recommendations.
Awesome. Thanks so much. Charisse, you want to talk a little bit about your journey?
Yeah, I'd say one of the things that's underappreciated in the marketplace about what gets you institutionally ready is, yes, you've got to be a great investor. Yes, you got to have a great track record. But actually having a really strong infrastructure makes you ready for institutional capital in a way that we did instinctively, largely because I grew up at Morgan Stanley. I managed a large balance sheet internally. I had to work with a number of different constituents. So internally, I knew I was used to having finance and ops and tech and data systems and et cetera. So for me, in order to manage my business, it was a key place where I invested instinctually, just because it was what I needed. But it also turns out in conversations that I've had with some of our current clients that we're looking at onboarding in the LP space as well, that having that infrastructure made it easier to invest with us as a first-time platform. And so I do think that GPs who do think about how to thread the needle, because it can be expensive, but how to thread the needle of creating an infrastructure that can run as an institutional gold-plated infrastructure actually can be a motoring part of your growth. So, we tell the team internally all the time when I kind of talked about early on that Voltron effect, it's true for our front office and for our infrastructure as well. And so we treat the team very similarly, because you could do a great investment, you could throw up a 5x, sounds good, but you wouldn't have got that investment if we didn't have a strong compliance function, if we didn't have a strong CFO, if we didn't have a strong person catching the things that they need to catch on the infrastructure side, and being a great person to support the investor relationship management as it relates to communicating with our partners. And so you can't do it alone. And so we try to make sure that there's no hero complex. And that's, jarring for people who grow up in these big firms where the frontline people are always the people who are celebrated, and the people doing the dirty work in the backyard, picking, digging the dirt and planting the seeds for the infrastructure don't always get as much love. But here we're really focused on that, and we're intentionally focused on that. And because we do think it makes a difference to the experience and to our ability to scale as an institution.
Sharice, thank you. That's very, very helpful. Tina, do you want to anchor this discussion with respect to, sort of the journey to access to capital?
Look, I'll end with a little story. There's this, when in the discussion around access to capital, there's this discussion around pattern matching, right? Jen, you are highly unusual. I wish in the sense that you actually go in where most don't go, right? And you are but it's been profitable, it sounds like, for you. But there is this notion of pattern matching, particularly in venture capital and private markets, where people look like they invest in people that look like themselves, because that's their model of success. The gentleman that invested in me is a white man from the South in 1996. And so I had lunch with him, and I said, Fred, why in the world, why did you break the pattern? And what he said, and it kind of resonates with something that Sharice said, you clearly believed in what your mission, and you had a track record, but lots of people have track records, but you clearly believed in what you were about, what your company should be about. You're someone that has overcome lumps. That was his word, but what he meant was, he said, you're going to have rough years, you're going to have investments that don't work out. And so the question is, how do you handle it? How do you extricate yourself from it? How do you treat your people? How do you treat your LPs when things don't go as planned? And then on infrastructure, that is absolutely key. One of the ways in which we work with strategic partners is to, help them either to provide capital or provide sort of best of class, advice on best of class providers. And so I just thought that would be a good story to end that question with.
Awesome, Tina, that's so helpful. I want to thank you all. We do have 3 questions from the audience. Why don't I read question 1 and then maybe just throw it out to anybody that wants to answer it? I think this one is a softball, so we'll open it up with this one. Question 1 from a participant asks, how can we as institutional investors better support diversity in asset management? And how can we recognize diversity of gender?
I'm happy to start. I think one of the things that would be super supportive of GPs that look like me or others in the marketplace is really thinking through some of the not criteria is the wrong word, because I don't want you to think that I'm asking you to change your criteria, but some of the boxes that you typically ask GPs to check, think about them differently, right? I was not and am not rich. I hope to become rich one day, but asking GPs to commit scores of millions of dollars to launch products as a point of alignment is actually something that can be, again, that expensive store that people can't walk through. And if the folks that do actually have it, that might be disposable income for them rather than being as impactful as their name hanging on the door. So for me, Harborview is the name of the town that my father grew up in. So it's not my last name, but it feels like my name is on the building. And so this is more than, the 1% GP commit that I'm asked and required to do. It's about my reputation. And so that's actually more alignment than any number that you can put on the table. And so think about things like that, or things like, managers coming out of larger platforms where they have been an investor, but they do not have attribution for their track record. And that attribution is strategically designed to not follow you, yes. Right? And so if that's the case, and you're coming from large firms that get all the money, that are homogeneic and what they look like, how do you think about creating space to understand those managers, given the set pool of facts? So I would just think about the infrastructure of the thing that you're trying to get at and see if there's other ways to solve it. I grew up as a structured finance person, so you structure anything. And so as I think about the criteria, just thinking differently about those things, I think can be really supportive of GPs in this space.
Yeah, I'm gonna front run Tina on this one a little bit, because I think I know her answer too. But number one for us is just cast a wide net, and don't limit yourself to preconceived notions, ideas, definitions, things like that can really constrain you. And we're always kind of talking about that greater than 50% ownership, women ownership, and I think that's a good place to start. But you really you have to kind of think a little bit outside of that and understand that, ownership is terminal. You need to have a strong, base, middle. You need to be able to promote from within. It has to be, sustainable and long-term. And the way to do that is really the way, Sharice has built her organization. And that's what I look for in managers when I'm flipping through, pitch books, and you get to that picture page, and, you can be as, diverse at the top, but if there's not the ability to, promote from the bottom on up, I don't think that's a long-term way of looking at it. I think you need to, also educate your committees to be like-minded there too, because they have that same kind of ownership mindset. So being able to kind of, talk the talk and walk the walk with them is important as well. I'm trying to think what else that I'd advise everyone. I think it just comes down to, again, partnerships too have been important to us, and creating partnerships with our managers who can help us to expand that network, getting involved in your local investing networks, things like that, just sharing ideas. It's the best way to find, opportunities, because they sometimes just, they're not going to come knocking on your door, and they don't always happen just organically. So it's a good way to, I think, expand your base and network and sourcing opportunities.
I think what I would say is, look, why do this? right? You're doing this because it's an opportunity to earn outside alpha. I know that's a public markets term, but you get the point. Because this is a segment of the market that is growing faster and has been shown study after study to outperform their larger peers. So that's that. So if you start there and then you say, okay, what are the criteria that prevent me from accessing the universe, and which of those criteria are meaningful, or are they there for just because they've been there for years? Are they actually, so Sharice just mentioned one, or a 10-year track record or something like that. Is that really that meaningful in this context? And so to be thoughtful about what's the investment opportunity, and then again, what criteria are important, because you have to use them to select skillful players. But some criteria, they're simply because of legacy and not necessarily because they lead you to the best choices. And as to what Jen said, really, this is also about building sustainable capacity. So if, I can think of any combination of ownerships that get you to 51%, but if the diversity hangs simply on the owner's status, and no one else is diverse, that meets the technical definition of diverse, and there's nothing wrong with that, but I'm not sure if that's the best model for building sustainable capacity. And that to me is the best of class model that certainly we seek.
Absolutely. Thank you for that response to that question. Question 2 is more of a 2-part question. The first part is with respect to structuring. Specifically, what are the best economic deals diverse GPs can strike in GP stakes and seed transactions?
Maybe I should offer that.
Please.
I don't want to play their hand. So I would say, looking for a couple of things. You want to make sure that you're getting somebody who's a partner, as I mentioned. So that's, to me, more important than the dollar. Then secondly, on the dollars, it's really around some combination of getting some working capital, which is what you're really trying to get when you're getting a GP stake done, unless they're an LP that's staking with a large. So you're either going to get working capital to operate the business itself, or you'll get somebody who can be a large large LP as your staker, and they get some revenue off of your business overall, and that gets the momentum rolling on your fundraise. So those are 2 outcomes that you can go down. And I would say having terms that look like, some points on the business. Again, as Tina mentioned, the minority stake, try to think about what else you have around the business. Team members that you have to compensate. Is this your first investor or your second or third? How do you bring all that together? Making sure that you have a path to reclaim the economics over time. And it's not because people aren't great partners, but you do want to be able to reclaim the economics over, after a period of time. So negotiating how you think about that buyback or sunset in some instances, some of these revenue shares. And I prefer personally a revenue share in many instances. To the extent I can get it, rather than equity, unless that equity partner is a partner I trust, believes in my vision. If they're not, I want them only to have revenue share. It's almost like a tax. It's like the Holland Tunnel. You pass through, you pay a toll, you go on the other side, you're gone. So you have to think about who the partner is and what it is that you're getting from them. And so trying to keep those as small as possible, because what you're then going to face as you go to talk to the institutional LP market is people want to understand that you and the team are controlling the vast majority of the economics. And so trying to constantly keep that in check is a struggle, because you need working capital. All these solutions are bespoke. Feel free to reach out to me on LinkedIn. I'm happy to give free advice. if you're negotiating. And always, 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 always have more than one bid. I mean, under penalty of death, do you take one that you only negotiate with one person, because you then kind of leave yourself in a non-leveraged situation, and that doesn't feel good, because they'll, depending, if they're not a good partner, they may not be very kind as it relates to what they take from you and on the other side of it. So
Absolutely. Sharice, thank you. Yeah.
I would summarize everything that Cerise said as alignment. You have to make sure, whether it's, and it is a minority stake, but even with rev share, I mean, clearly you don't, alignment is not as important for rev share deals, but you want a partner that appreciates what you're trying to accomplish and help you accomplish them.
Correct.
And it helps both sides. And I've been on both sides. I've been staked, and now we have a GP staking firm. So I understand. And so, the concept of alignment, in that you want a partner that has the capacity, the interest, the passion in seeing you grow.
Mm.
At the end of the day. And you can build in all kinds of protections when things go awry, and that's just good practice. But at the end of the day, it really has to be about two partners that trust each other and that can sort of help each other achieve their objectives.
that's right.
Great. So the second and final questions are with respect to the who in the LP space. Who? So specifically, Jen, how can we find more of you? Who are the
You salespeople need to do your jobs.
Exactly.
who are the GPs? Who are
I
the
can't do your jobs for you.
That's right. So who are the go-to LPs that support GPs in these types of structures? That's part one of the question. And secondly, it's more specific. It is, I guess there's some public pension plans on the line. And should larger public pensions focus on GP investing and staking, or look to sort of more direct GP and GP stake investments?
Yeah, so I mean, if you have a team that can do direct, that's great. Should you do it? I mean, I think it's a great diversifier for anyone's plan portfolio. Requires a little bit of education at the committee level. But as far as the opportunity set that's out there, if you're a large plan, maybe you're not as focused on lower middle market, maybe the dials of the, and I'm dropping names now,
Yep.
but maybe the larger players of the world have kind of given it a little bit of a bad name, because, they don't necessarily do it for the right reasons. It's not the partnership reasons, which I think is the true reason you want to be investing in these types of strategies. You're just not going to get the returns that you want out of it if it's just, writing a check. But I think, if you look at the numbers behind the investment thesis, it's not a hard lift. I mean, we go to, ask our committee for a lot of strange things, and this one is not a hard one, I don't think, to have to get committee buy-in for. I think it really fits a place in the portfolio. We don't look at it as direct, as equity risk, or it's not necessarily all fixed income either. It does fit that kind of hybrid space. So I think, as far as being an allocator, to me, this is an easy one to get past, to get through to committees, to get comfortable with, to understand the economics behind. The exits are a little bit more, challenging, I'll say, but not impossible to overcome. If you're, again, call me, talk to me. I'd be happy to help people and educate people on the space as well.
Thank you. Tina, do you want to offer a response to the who, and should public pension plans be involved directly or indirectly in this space?
Yeah, I did see that question. Look, it's a direct, if you have experience in staking, clearly, that is a path for you. It is, each deal, as Sharice just mentioned, is bespoke. And so unless you have folks that are used to structuring those kinds of deals, then, this is shameless, but someone like XDO might be able to help you there. But the other thing we at least try to provide is diversity of strategy. So we stake real estate firms, we stake infrastructure firms, credit, private credit, buyout, although that's less of an emphasis of late, and interesting strategies like Sharice's. And so you get a diverse set of risks exposures to the private markets that at least we provide. I can't speak for others. And you get that sort of the interest in economics that Jen mentioned, where really a double-digit cash-on-cash yield and the upside economics through participation in carry and strategic exits.
Tina, I think that's a great way to anchor this discussion. We have more questions, but we certainly want to entertain your one-on-ones. We're all available at any point on LinkedIn or through our website, but we certainly want to encourage this dialogue and to engage in greater ways with all of the participants on this call. We are so grateful for your time and for your attention and for your great questions today. And certainly with our partners at IEN, this is only the beginning and we look forward to talking further. Thanks again, everyone.